So we're going to move on to the last one, to our valuations. And I'm going to return to my editor. Okay, so we'll continue working here now with valuations. So I'm going to create a new variable, valuation equals to stock.valuation validation. Stock.valuation measures. Valuation measures. And we're going to use the latest 5. So I'm going to say tail 5. Tail 5, it means we get the latest 5 values, the latest 5 values. So again, I'm going to reset the index. So df valuation dot reset index to get only one header. And I'm gonna call it df2 equals to df.transpose to get vertical information, and I'm gonna display the data frame. So st data frame equals to df2, and the width is gonna be again 1800, and height is gonna be 800. Okay, so now our application should be finished. If I haven't made any mistake, I'm going to save it and I'm going to check if it works. Latest valuations. Okay, so here we have the information of our latest valuations. We have the period type, which is quarterly, and this is TTM, is trending 12 months. We have the enterprise value EBITDA ratio, enterprise value revenue ratio, the forward price to earnings ratio, the market capitalization, the price to book ratio, the price to earnings ratio, the PEG ratio, and the price to sales ratio. Okay. So our application is finished. We have all the information we wanted to display, and we can look for any stock we want. So we can check Tesla, and you can say from 1st of November. It can take a while, depends on how fast the API of Yahoo is working. So normally it goes very fast, but so here we have the information of Tesla. Tesla has an expected annual return of 14%. I already said in the beginning of the video that this is not correct because I'm only having 20 days of information. If we want to have a very accurate value of this one, we should to specify minimum 5 years of trading information. So this value will be more 183%, and we'll check with the cumulative returns. It's possible because Tesla went up very much. So yeah, it went up like 10x. So it's normal we get 183%. We have a standard deviation of 64%. It means that we take double the risk with Tesla, but we can have double the rewards if we compare it to Apple. And maybe we can check for a more stable company like Pepsi. Say enter. And you see from Pepsi we have a expected annual return of 14% with a standard deviation of 21%. We're going to look at the latest valuations of Pepsi and fundamental information. Okay, so our application works, and that's how we make a simple analyzing tool to check for our information on stocks.